Alright, let me tell you a story. A few years ago, I knew this guy. Let's call him Alex. Alex was smart, worked hard, but he always felt like he was running in place financially. He had a decent job, yet at the end of the month his savings looked disappointingly empty. He told me he just didn't have big chunks of money to invest. He saw people talking about buying stocks and he felt left out, thinking you needed thousands to get started. It felt like a private club he wasn't on the list for, a feeling I know many people share. One day he mentioned his daily coffee habit. He'd spend about $5 every single morning on a fancy latte. It was just part of his routine. So I asked, "What if you invested that $5 instead?" He laughed. "$5? What could that possibly do?" It seemed insignificant, like trying to fill an ocean with a teaspoon. He couldn't see how such a tiny amount could grow into something meaningful. The idea felt ridiculous to him, but the seed was planted. We did some quick math, $5 a day, about $150 a month, over a year, $1,800. Suddenly it didn't seem so small. You don't need a huge pile of cash to begin. He could start with the small, consistent amounts he was already spending. Small regular contributions build wealth over time. That's the core strategy. Turn daily habits and pocket change into a future fortune without the pinch. Alex decided to try it. He cut back on coffee and set up an automatic $5 a day transfer into a low-cost index fund. He paid himself first, before the coffee shop. At first he barely noticed. After a few months he checked his account and was shocked. His balance was growing, slowly but surely. He was finally in the game. That shift in mindset, from a one-time event to a daily habit, completely changed his financial future. Chapter N/lead-in. What exactly is dollar cost averaging? Let's break it down. It's called dollar cost averaging, DCA. Don't let the name scare you. It's actually very simple. Invest a fixed amount of money at regular intervals, regardless of the market. $5 a day, $50 a week, $200 a month. Key: consistency. Here's a simple example. Invest $100 every month, into a stock or into an index fund. We'll show the math with a single stock price changing. Month 1, price equal, sign $10. $100 buys 10 shares. Month 2, market dips, people panic. You don't. Auto invest runs, price equal sign $5. $100 buys 20 shares. Month 3, price equal sign $20. $100 buys 5 shares. After 3 months, invested equal sign $300. Shares 10, 20, 5, total equal sign 35 shares. $300, 35 equal sign about $8.57 per share. See that? You bought more when cheap and fewer when expensive. That's DCA's power. It removes guesswork and emotion. You're not a market genius, you're consistent. Over time, consistency builds serious wealth, turning small regular investments into a nest egg. Now you might be thinking, okay, DCA sounds cool, but what if I get a big chunk of money? Shouldn't I just invest it all at once? That brings us to the classic debate, DCA versus lump sum investing. DCA equal sign recurring disciplined entries, lump sum equal sign one big bet on the market today. Both have pros and cons, let's compare. Lump sum investing is exactly what it sounds like. You take a single large sum of money and invest it all in one go. You're essentially making one big bet that today is a good day to buy. Let's imagine you have $12,000 to invest. With a lump sum approach, you would put the entire $12,000 into the market on a single day. If you get lucky, and the market goes on a massive bull run right after you invest, congratulations, you've maximized your returns. Historically, lump sum often leads to slightly better returns, about 2/3 of the time, because markets tend to rise over the long run. But it comes with a huge if, timing. What if you invest right before a major market crash? Imagine watching it lose 30 or 40% in the following months. Psychologically devastating. That experience can scare people away from investing for good. This is where dollar cost averaging shines. Instead of investing $12,000 today, invest $1,000 a month for a year. If the market drops, you're not panicking, you're happy. The next monthly investment buys more shares. DCA smooths out your entry into the market. It's less about hitting a home run and more about consistently getting on base. For most people, the peace of mind and reduced risk that DCA offers far outweigh the potential for slightly higher lump sum returns. Peace of mind matters for long-term success. If you value lowest risk and steady progress, DCA is often the right choice. If you can tolerate timing risk and the market immediately rockets up, lump sum can win. Why DCA is your secret weapon against market madness. One of the biggest obstacles to successful investing isn't picking the right stocks, it's managing your own emotions. The market is a roller coaster of fear and greed. When prices soar, greed. When they plummet, panic. Those emotions cause people to buy high and sell low, the exact opposite of what you should do. It's a trap that has cost investors trillions over the years. Dollar cost averaging acts as a powerful circuit breaker for these destructive emotions. It automates your investment decisions. It forces discipline even when your brain screams the opposite. Think about it. When news screams crash, your DCA plan still buys. You don't have to summon courage to click buy. The system does it for you. It turns fear into opportunity. For a DCA investor, a market dip is a sale. You get the same assets at a discount. That mental shift is powerful. You start to see downturns as opportunities. It lowers your average cost and sets you up for bigger gains when the market recovers. Ultimately, DCA reduces stress because it simplifies decisions. You don't need to check the market every day. You don't need endless financial news or pundit predictions. Your strategy is set. One simple rule: invest a fixed amount on a regular schedule. That frees mental energy to focus on income, savings rate, and goals. It's a boring strategy, and in investing, boring is often beautiful. Slow, steady, stress-free. Transition. Next, how DCA works for people at different life stages. The beauty of DCA is that it works for almost everyone, regardless of age, income, or expertise. It's a truly democratic investment strategy. You don't need a finance degree. A college student can start with as little as $25 a month. 25, 50, small amounts build habits, giving money the longest possible time to grow. Consider Sarah in her 30s. She gets paid bi-weekly and uses her 401k to DCA automatically. Every payday a fixed portion buys into her chosen funds. That's DCA in action, retirement on autopilot. Mike, a freelancer with variable income, can set a baseline $200 monthly and add extra when he has surplus. A hybrid approach keeps consistency while allowing flexibility. Even retirees can use dollar cost out, sell fixed amounts to avoid panic selling during downturns. From beginning to end, systematic transactions smooth risk and manage exposure. Discipline is the common thread. Transition. Next, the long-term benefits. When you zoom out and look at the big picture, DCA benefits become crystal clear. They are incredibly compelling for the average investor. Reduced risk, lower average cost, and discipline. First, reduction of risk. Spreading investments over time avoids catastrophic timing risk. You diversify entry points, which smooths the experience. Confidence to stay invested for the long haul. Second, DCA lowers your average cost by buying more when prices are low. This advantage works silently in your favor. It compounds over years with minimal effort. Third, it builds discipline. Saving and investing is a habit like going to the gym. Automation removes willpower decisions. You pay yourself first. That discipline forms the foundation of a sound financial plan. Finally, DCA makes investing accessible to everyone. You don't need to be wealthy or a wizard. A small, consistent amount and time are all you need. A simple, powerful strategy for a secure financial future. It levels the playing field for everyday workers, but no strategy is perfect. Let's be honest about the downsides. Lead in. Are there any downsides? Let's be honest, no investment strategy is perfect. Main argument, DCA can sometimes result in lower overall returns versus lump sum. You pay an opportunity cost for reduced risk. If markets enter a strong, sustained uptrend with few dips, DCA underperforms because cash sits on the sidelines. Money not yet invested misses market growth. In that case, lump sum would have been optimal. Transaction fees were once a concern for frequent small buys. Today, commission-free platforms have largely solved that problem. Finally, DCA requires patience. It's a marathon, not a sprint. Growth can be backloaded. Early years feel slow. If you lack patience, DCA can be psychologically challenging. Lead in, let's boil it down to the essentials. Okay, we've covered a lot. Let's boil it down to the essentials. If you remember nothing else, remember these key points. First, DCA is simple. Invest a fixed amount at regular intervals. That's it. It doesn't require genius or a finance degree. The goal is consistency, not predicting tomorrow. Second, DCA takes emotion out of investing. It acts as your emotional guardrail. It forces you to buy consistently whether markets are up, down, or sideways. Third, it lowers your average purchase price over time. Remember the trade-off. Reduce stress and risk versus potential slight opportunity cost in a non-stop bull market. For most non-professional investors, that trade is worth it. It's reliable and time-tested for turning small, consistent savings into life-changing money. Ready to start? Here's how. It's easier than you think. A few simple steps and automation. That's the magic. Lead in. How to start DCA today. So you're convinced. You understand DCA. You're ready to put your money to work. Getting started is simple and can be done in a few steps. First, you need a brokerage account. Pick a reputable brokerage. Fidelity, Vanguard, Charles Schwab are examples. Opening an account is usually free and takes about 15 minutes. Next, decide what to invest in. For most beginners, a low-cost broad market index fund or ETF. Consider S&P 500 trackers like VOO or FXAI, or total market trackers like VTI or FSCAX. These funds give instant diversification across hundreds or thousands of companies. You're betting on long-term economic growth, not single-stock picks. Step 3. Set up automatic investing. This is DCA magic. Link your checking account inside the brokerage. Tell the system how much and how often. Example, pull $50 every Friday. Automatically buy shares of your chosen index fund. Then be patient and let it work. The hardest part is not touching it. Don't panic on dips. Don't get giddy on surges. Trust the process. Focus on growing your income so you can raise contributions over time. Follow the steps to go from spectator to investor. You can start today. Small, consistent actions compound into big results. Set it up, be patient, and keep contributing. If this helped, like and subscribe for more simple finance explainers. Thanks for watching.